Hi class, today we're going to see a video on Goodwill, specifically Goodwill, and multiple choice questions and other exercises. So we should really get a good understanding of Goodwill for this week 1 in Intermediate Accounting 2. So here, let's start off with an example. Here's an example of a company purchase, and we're dealing with book value and fair value. So Sarah Company acquires Trevor Company and purchases net assets of $790,000 cash. Independent valuation of Trevor's net assets results in the following reported fair value and book values. So book value, this is what's on Trevor Company's books. Fair value, what we base Goodwill off of, is the value that Sarah Company is putting on these assets. So it's easy to verify the cash with bank statements from banks. So that's going to always be the same. Accounts receivable, it's the same amount, but the acquiring company could say, okay, I think the allowance for doubtful accounts should be a little bit higher, making that net realizable value lower. But in this case, it's not. Inventory is different, and one of the main drivers here is, Trevor Company could have used LIFO. And maybe the acquiring company is based on that fair value off of first in, first out. So differences can occur there. Property, plant, and equipment. Usually this line item, you can get an appraisal. Same with inventory as well. But you can get an appraisal on property, plant, and equipment and have individual appraisers go out and check out whether there's buildings in here and land, and get a harder value that way. So we have a big change in difference between book value and fair value here. Trademark, we can see in the past a trademark was not properly reported on the books. It was probably expensed as incurred, all those costs. So what Sarah Company here is, they're putting a value of $130,000 on that. Notes payable is the same. So the difference here is 145 to 390. So what I want to state here is basically we're not going off the book value. We're going off of fair value when we try to determine Goodwill. So here's what the journal entry would look like. And right here, the Goodwill, consider this like a question mark over here. There's not going to be anything here. So we're going to record all the fair values. So these are going to be all debits. So the 75 all the way to the 130, these are the assets. So these are going to be debits onto Sarah's balance sheet when she purchases, or when they purchase. We're going to record the note payable. And we're going to also record the cash price that we pay. So this is outgoing, and there's going to be a credit of cash. The difference between the debits and credits will be the Goodwill. The Goodwill, again, is the excess of the purchase price over the fair value of the assets being acquired. So let's look at some questions, multiple choice questions. In the business combinations, companies record identifiable intangible assets that can be reliably measure. All other intangible assets too difficult to identify or measure are recorded as other assets, indirect costs, goodwill, direct costs. So the answer here is going to be C, goodwill. So the key word here is that we can't identify. Goodwill can't be identified on its own. It can't be ripped apart from any of the assets in the company. The only time we can record goodwill or purchase goodwill is when we acquire another company. Goodwill may be recorded when A, it is identified within a company, B, one company acquires another in a business combination, C, the fair value of the company's assets exceed their cost, D, a company has exceptional customer relations. So the answer here is B, one company acquires another in a business combination. Goodwill is A, amortized over the greater of its estimated life of 40 years. B, only recorded by the seller of the business. That's not the correct answer because it's only recorded by the buyer of the business, so we can exclude B. The excess of the fair value of a business over the fair value of all net identifiable assets, and D, none of the above. So it's not going to be D. So amortize over 40 years, that's not correct, because goodwill is never amortized. It's actually prohibited by GAAP. So the answer here is C. The excess of the fair value of a business over the fair value of all net identifiable assets is correct. So let's look through a couple of examples. Juliana Corporation purchased all the outstanding stock of Goodwill, paying $2.7 million cash. Juliana assumed all liabilities of Goodwill. Book value and fair value of acquired assets were, okay, so they made it a little bit easy here. Book value, fair value, current assets. So this is basically the cash, inventory, accounts receivable, anything in the current assets, like inventory, anything that's an asset that's not non-current. Property, plant, and equipment, 2.2. So current assets were 450,000. We add these two, and what we do is subtract the 600, and we have that number here. We're going to take the 27, subtract that number, and we'll get goodwill of 600,000. So consideration given, same thing as the purchase price. We're going to subtract the fair value of net assets, which is going to be the 450, the current assets, PP&E, that's 27. We subtract the liabilities, we get 21. So 27 minus 21 equals 600. So it's really, it's an easy concept, but in some questions, they may try to confuse you, especially on the CPA exam. But I've seen some in this text and other textbooks that kind of just give you extra information that you don't need. So same premise here. Lake Incorporated purchased all the outstanding stock of Huron, paying $950,000 cash. Lake assumed all the liabilities of Huron. Book values and fair values of the acquired assets and liabilities were over here. So basically, we're going to do the same thing. We're going to take the 950 and subtract the addition of these two minus this. So here's another illustration. 9.5 fair value of net assets is the 125, 750. Again, we focus on the fair value, not the book value. We subtract the liabilities, 175. So 950 minus 700 equals 250, and that's D. So which of the following assets, if any, occurred this year in exchange transaction are potentially amortizable? So goodwill or trademarks. So we know that goodwill can't be amortized. So C and D are incorrect. So it's either between A and B. Trademarks can be amortized. So the correct answer is A. Goodwill, it's not amortized, but there's a process, and we'll show that in a different video. Goodwill is tested for impairment, at least annually, but again, never amortized. Trademarks are amortized, but only if they have finite useful lives. Keep that in mind. So when we amortize a trademark, it's going to be the lower of the useful life over its legal life. Actually, the lower of the useful and legal life. Which of the following costs of goodwill should be capitalized and amortized? So in other words, which of these costs, maintaining goodwill or developing goodwill, will be put on the balance sheet and amortized throughout a period of time? Excuse me. So maintaining goodwill and developing goodwill. So the answer is A, neither. So goodwill, coming from the business combination, so when one company buys another company, it is capitalized, and we've actually seen that in the previous examples where it was actually the plug figure. However, like I said before, amortization of goodwill is prohibited by GAAP. More importantly, the cost of developing, maintaining, or restoring any intangible asset, including goodwill, is actually expensed. So if it's not specifically identifiable, which is goodwill, has indefinite useful life, we don't amortize it. Goodwill is an example of that. or inherent in a continuing business and related to an entity as a whole are expensed as incurred. So in short, we capitalize goodwill, but anything that we do to maintain goodwill or develop goodwill is just expensed, thrown on the income statement. So any questions? I know this was a relatively quick video. Any questions, feel free to just post in class. And thanks for listening.